Hello, my name is Carl Walker, Director at Hughes Ellard, one of the South's largest and fastest growing commercial property consultants. I thought it might be of interest to provide a quick overview into how the specialist investment market has recently performed and what things might look like throughout 2012. The first few months of 2012 have seen a marked change in the investment market. Smaller investment lots remain attractive in all sectors, especially below the £250,000 stamp duty land tax threshold. The cash is still there, but investor confidence has dropped since the Christmas break. Couple this with limited bank funding and the market is thin, although values are generally being maintained. Single-let industrial and retail in larger sizes is harder to price. The loss of confidence from the end of 2011 could just as easily be reversed given that there are a few more attractive options available in alternative investment sectors. It was this lack of attractive alternatives which kept interest in property comparatively high in 2011, notwithstanding concerns about the long-term fundamentals and increasing rates of vacancy, particularly for retail. For certain funds and property companies, multi-let industrial property remains attractive. The sector is reasonably robust, vacancy levels along the M27 corridor tend to be low, there is no new stock being developed, and the multi-let nature of the estates offers a spread of risk. Late 2011 saw the sale of Titchfield Park to Highcross at £6 million, a sale handled by Hughes Ellard on behalf of Greater Manchester Pension Fund. In 2012, big ticket prime stock is where the market is at. As a local example, Scandia House in Southampton, a top quality building on a long lease following a lease regearing by the owner pension fund in 2011. It's now being offered at 6.75%, and increasingly stock of this nature is being offered nationally and finding buyers. Contrast this with multi-let office buildings of an older type and secondary nature, often featuring voids and short leases. This stock is almost only able to be valued vacant for alternative use as development stock, typically residential or hotel. When talking vacant possession values, we have seen transactions throughout 2011 at £25 to £30 per square foot for part-let buildings, notwithstanding the fact that the owners have often invested in and maintained the building services to a good standard. To put this in context, one can compare with the new build cost of offices, which is £100 per square foot or more. Even with newly built offices, Helical and City Estates' purchase of Phoenix House from the receiver was at a purchase price little more than the build cost, this for a Grade A specification building. Unless we're talking about very small investor lot sizes or very well secured long-term rents, pricing income, particularly from office investments, has become very difficult indeed. Those in the market are motivated by the alternative use prospects. Few have any illusions that they will be able to re-let vacant space at a rate that would see them ahead, particularly in the context of void rates at maybe £5 per square foot and void service charge levels typically at £5 to £7.50 per square foot. Only a shortage of office stock, increasing rents and reducing incentives is going to restore any value to this sector. That's it from me for now, but if you'd like to discuss any aspect of this commentary, please do not hesitate to contact me on 01329 22 0033 or email me on cwalker@hughesellard.com. Alternatively, take a moment to look at our website www.hughesellard.com.